Let's talk about managing cash flow and improving cash flow by managing your liabilities. So the biggest liability on a lot of small businesses' balance sheet is the accounts payable, which is your unpaid bills. So you have to have good systems in place with your accounts payable to make sure that at any point in time you can see an accurate listing of who you owe, how much you owe them, and when you owe it. And you want to manage those accounts payable, taking advantage of terms that your vendors are providing to you so that you're let going of cash as slowly as possible. You want cash to go out the door as slowly as possible. So managing your accounts payable, have good systems and processes in place so that all bills are entered as soon as they're received or as soon as you're aware of them, so that you can see the timing on when money has to go out the door. The other part of managing the liabilities of your assets is making sure you have the right kind of liabilities in place to finance assets, for instance. So make sure you're using the right kind of debt for the right purposes. A line of credit. Let's talk about a line of credit. Many small businesses get a line of credit because of seasonality in the business. There may be peaks and valleys in the cash flow because of peaks and valleys in the revenue streams. That's a good use of the line of credit to finance those periods where there's a shortage of cash flow. And then in the periods of the high season, when there's a big cash inflow, you reduce that line of credit. What I see too many businesses getting in trouble with is building up that line of credit and not paying it down in the time of the year when they should be paying it down. And then they're in trouble because the line of credit is used up. And a lot of times, bankers aren't the best at recognizing that situation, and they'll take that situation and want to turn that line of credit into a term note to make sure that they're getting some of the principal paid back over time. That's a bad use of a certain type of debt. Also, when you're financing equipment, don't finance a 3-year useful life on a piece of equipment with a 5-year note, so that at the end of 3 years, you're looking to replace that piece of equipment, but you've still got 2 years left on the note, on paying off the debt. So analyze your debt, make sure you're using the right kind of debt for the right purposes, and also manage your accounts payable, manage your short-term debt so that you're letting go of cash as slowly as possible and enhancing your overall cash flow. Thanks for watching, and if you find value in what we just talked about, click the link below, get our full cash flow management and improvement guide, or go to the website and you'll find it there as well.